Investment services offered through Global Private Financial Capital. Andrew McNair is a solicitor for SWAN-Capital.
What your money would say. Andrew McNair. Money Talks. Are you listening? Money Talks. Are you listening? Money Talks. Are you listening? What your money would say with Andrew McNair.
We're live here on What Your Money Would Say. I'm your host, Andrew McNair. And for the next 30 minutes, every Saturday from 12:30 to 1 o'clock, we'll be taking financial chickens and making them financial swans. But what does it mean to be a financial swan? Well, at SWAN-Capital, we believe that you should sleep well at night. Because let's face it, you've worked 30 years at the base. You've worked 30 years for the local power company. And you saved money in your 401k plan. You even put 3 kids through college, and you found a way to even give money to your charity and to your church along the way. And it's time for you to finally sleep well at night in your retirement years. And I like to joke with my clients, it's our job to enjoy the responsibilities of your retirement so that you can enjoy the pleasures of your retirement. And today we're going to talk about the zero interest economy. But before I do that, I want to share with you a white paper that's downloadable at our website at swan-capital.com. That's swan-capital.com. And it's our white paper that's called Is College Worth It? So if you have a grandchild or a child that you're looking to save for their college, you don't want to miss this white paper. You can go to swan-capital.com to download it for free. Now, today's show is going to be about the zero interest economy, and I've been looking forward to bring on Chris Sleight, who's the managing director at Global Financial Private Capital. Chris, welcome to the show.
Hey, Andrew. Thanks for asking me to be on.
Well, I've been looking forward to bringing it on and talk about, we've been talking for the last few weeks about the CD treadmill. So many retirees were used to the 5 and, 6% interest-paying CDs. They used to live off the interest in those good old days. But, since those CDs are not paying that anymore, where do retirees go in this zero-interest economy?
Well, that's a terrific question because with so many families retiring today and giving up that paycheck and experiencing what we call that income gap, more and more families are having to look for different solutions than what they or their parents maybe were comfortable in. Let me tell you what we're doing at Global to drive consistent, reliable income for our select families and the advisors that we represent. When you look at our main portfolio for income, it's called Conservative Income Portfolio. It's run by our Chief Investment Officer, Chris Bertelson, and the philosophy behind that is making 4 to 6% of consistent, reliable income. And what we tend to do is we buy companies that create products that people use in good times and bad. And what I'll ask people to think about is, think about what you did by 8 or 9 o'clock this morning. In most households, we talked on our phone or cell phone, we turned on our lights, we ran our water, and in some households, we took our medicine.
And hopefully brushed our teeth.
Yeah, exactly right. So we tend to own telecommunications, energy, utilities, and drugs. These are the places that drive consistent, reliable income through something called a dividend. And if you think back of what your parents and grandparents used to buy, they would buy the mall bells, the utilities, those things that paid that dividend. They were called the boring companies, but in this day and age, to be able to drive that sort of income, we're looking for some of those boring stock companies that pay that consistent, reliable income. And that's how a lot of our families and institutions are enjoying consistent income during the 0% interest rate time.
That's a great point, is own what you know. And, a lot of times we get, where we're investing, in futures on the moon, some wild speculative investments, or even worse, we don't even know what we own. Right, Chris? And it's a scary thought that we're putting our hard-earned life savings into investments that we don't know about and that we don't use on a daily basis, so we don't get to see where they're working or where they're not working. Let's talk about conservative income. It's had a great performance. Of course, performance is not a guarantee of future result. We want to throw that disclosure in. But, Chris Burleson's done a great job of managing the portfolio that we use a lot for our clients.
It's been exciting to watch how the team at Global, the investment team especially, is being able to just continue to cycle through this. For example, up for the last 30 years, you could own bonds. And bonds were a terrific place to make consistent income. And as interest rates were going down, the value of bonds were going up. But now over the last 6 to 9 months, I've seen the investment team leave the bond world because we all know that as interest rates begin to rise, bonds are just going to get hammered. And now they're actually buying boring, safe stock companies like telephone, energy, utilities, and drugs to drive that income. And so I would just really tell families that this is a terrific time to think back and get back to basics. Nothing so sexy and exciting anymore. Consistent, reliable income through those standard companies that have stood the test of time and have been able to maintain their principal value over the test of time, and companies that increase their dividends.
Well, what a great point. Getting back to the basics is always a great thing to do because, with all this volatility, I'm hoping it has a lot of families to really question, where we've come. It's back to time to get back to the basics. And I'm glad you brought up the bonds because what I'm worried about is a bond bubble. Where we're seeing a lot of retirees, they're going from safe investments and they're saying, well, we can't make 0.8 in CD and keep up with inflation. So let's look for some other investments. So they're pushing themselves to more riskier investments, yet they think bonds are not risky. Are bonds, do they have risk, Chris?
Well, bonds carry a lot of interest rate sensitivity, but we need to draw a line in the sand here, Andrew. Most families that we're seeing as we're reviewing plans through our financial planning team for our top advisors like yourself, families aren't buying bonds. They're buying bond mutual funds. And that's a big difference. If I own a bond, it has a maturity date, and I get my par value back. But if I own a mutual fund of bonds, when we peel back that wrapper called mutual fund and we look at all the bonds they're buying inside that mutual fund, we tend to see bonds going out 20, 30 years in duration. And just the other day, we looked at a portfolio that was full of bond funds where the family thought they were really safe, and we were able to show them that with every 1% of rising interest rates, their bond mutual funds were going to lose up to 14% of their value. So, gosh forbid, interest rates go up 2% in the next couple of years. That portfolio is down 28%. And there's a family, again, who thought they were safe and are going to get hurt.
Wow, that's scary stuff. And if you're listening out there, I want to encourage you to schedule your no-cost consultation where we stress test your portfolio. What does the stress testing your portfolio even mean? What it is it's a 30-minute to an hour consultation where we sit down with you and we look at certain topics that you may or may think may happen. Like what happens if this Ukrainian crisis continues? What happens if low interest continues? What happens if high interest environment comes upon us or in a high inflation period comes? We can stress test these events in your portfolio to see what effect it would have on your life savings. And very few firms, unless you're partnered with a great wealth manager like Global Financial Private Capital, have the use of tools like these. So let's talk about bonds. We came down for interest rates, from the 70s, 80s, the really high interest rates, and we're swooping down to at the basement floor of interest rates. If we see an uptick, which, if you look at Janet Yellen's releases, they have to go up. And what's your thoughts about that? I mean, can they honestly stay this low for much longer?
Well, I mean this in the most respectful way, but because our job here at Global is to be agnostic. But we also tend to joke from time to time as we never underestimate the power of the government to make a decision that affects things in a funny way. And so what we have seen is we call this a war on seniors and savers, Andrew. We have been in a 0% synthetic interest rate environment for almost 6 years now. There's going to have to be a time when Mrs. Yellen is allowed to begin to move interest rates up. And as we see this moving forward and slowing down the tapering of stopping the QE1s and the QE2s and the QE3s and not printing so much money and not buying our debt for more than it's worth, there's only one place interest rates can go. And right now, this is a call to action to all families listening. You have a market at an all-time high. You have interest rates at all-time lows. Get in to Andrew and allow that portfolio that you have, climb on his stress test treadmill and let's pressure test it from all the things that you're afraid of. You know, those things that keep us up at night. Because of the technology that our select advisors like Andrew have, you do not have to be surprised anymore. And the real winners today are the ones that are looking at getting out on top, not allowing the next correction or the next interest rate rise to take away some of their life savings and then take action. Be one of the winners that takes a look now, and maybe consider getting your chips off the table on top of an all-time high and unilaterally stepping back into a plan that really suits you. Consistent, reliable income, conservation, preservation, the principle.
Wow, that's a powerful call to action. And if you're out there and you're listening and say, how do I call into the office to schedule that stress test consultation, I encourage you to call our office at 850-380-9558. That's 850-380-9558. Now, we've been talking about income for retirees. You know, when clients and prospective clients are coming to our office, I see a lot of growth investments, yet they're depending on the income from these investments. Can you shed some of the light of growth versus income strategies and how a listener can find out if their portfolio is designed for income or growth?
Well, I'd be glad to, and unfortunately, this is how we saw so many catastrophes in 2008. Is families just didn't know. In our industry, in the financial industry, we are all really likable people, but this is now time for families to take the business of their life savings seriously and make sure they have the right specialists on their team. And what I mean by that is we tend to find a lot of the retail stockbrokers tend to be accumulation specialists, which means they're about growth at any cost. Now, the good news to all families listening is we've had a federal government through its policy that has pushed the market from all-time lows of, say, 6,000 to 7,000 all the way back up to 17,000 points in the Dow as of closing yesterday. So now families need to decide, is the person who's looking out after my life savings, are they about growth? Is that what they specialize in? Or are they about income? Because we've had a market that's grown, so families have been able to get the income they need. But maybe it's time to look at hiring a specialist that says, whether the market grows or not, I've purchased companies for you that pay a dividend and pay an increased or rising dividend, which means maybe I won't see a whole lot of growth, but a lot of families that we meet and talk to say, hey, I'm not about growth anymore. I've already accumulated what I needed over this last 30 years. I need somebody that's not going to blow up my life savings, that somebody's going to be responsible for the principal that we sacrifice to save. And that's an income specialist. And then somebody like you even goes to the next level, Andrew. You've gone and hired your own institutional team, your team at Global. Because of the depth and substance of your practice, when you pull your select families together, that gave you buying power. So now you're the relationship director working directly to your families, and then you manage us. And we specialize in conservation, preservation, income-driven investing. But now's the time for families to really take action or just make sure they're okay. There's times I know when you do a stress test where you come back and say, you all are in really good shape. But if you are listening and you don't know, I think now's really the time to take a look at it. It's going to happen, and now's the time to understand whether you're going to be insulated from it or not.
That's a great point. And you talked about just not being in the know. You know, we find out, like Warren Buffett says, when the tide goes out, you find out who's skinny dipping. And the families that haven't stress tested their portfolio can find themselves at sea with no pants on. And you don't want that to be an embarrassing moment for you and your family, like so many families were embarrassed in 2008. And it wasn't because they were investing in bad stuff. They were investing in the wrong philosophy versus growth versus income. And what I like to encourage you to do is, take a leap of faith. Call our office for that no-cost consultation to stress test your portfolio. And this, the analogy I like to use is if a doctor orders a heart stress test to make sure that your heart is operating like it should, what he does is sometimes they'll have to put you on a treadmill and they'll stick little things on top of you on your chest to make sure that when you're, under the bad times, like if interest rates rise, like if the Ukrainian crisis continues, what happens if oil prices go up, all those little things that we can't control in this world, is your heart, or better yet, your finances prepared for those? So again, you can call our office at 380-9558. That's 380-9558. You know, the other topic we like to talk about on the show, Chris, is the difference between a fiduciary advisor and a suitability broker. Do you mind sharing with our listeners what the difference between the two is?
I'd be glad to. And I want to be very respectful of this. All of us, 20, 30, 40 years ago, we were able to take $25 and we were able to go down to our corner stockbroker, and he was able to take that $25 and sell us something called a mutual fund. And it allowed even couples like Renee and I, in the early days when we had very little, a place to start saving. We were allowed to step in with masses of millions of people with really small amounts and be able to start saving in the market. The problem is that gentleman who allowed us to start saving, he worked for a big stock company, and that company had shareholders. And that company created retail products called mutual funds that were really profitable to their shareholders and really perfect for an early day saver. The problem is diligent savers who are listening now on the radio, those people have saved maybe $100,000, $200,000. They've outgrown that retail stockbroker because that stockbroker has what's called a suitability standard. Because they deal with masses of millions of people, they have to sell you a product that's most suitable for you. Now, we all know what suitable means. It could be the least suitable, or it could be the most suitable. And for most of the select families we meet today, that's not acceptable to them anymore. They want to work with a fiduciary, somebody like you, Andrew, who wakes up every day, and you must put your families that you represent best interests first. You don't answer to shareholders. You don't even know what to pull off of a shelf until you've spent a lot of time with the family. And then your responsibility as a fiduciary advisor is to be able to build something that's best suited for each of your individual families, not necessarily the stockbroker. So I don't begrudge the stockbroker. They've allowed a place for families to start saving. Where I do have a problem is at some point families have been diligent savers, and I really think those stockbrokers should go to them and say, Bob, Mary, you saved $200,000. It's time for you now to let me go and go with more direct access to the VIP entrance of this world, where you have your own advisor who's a fiduciary, where you have your own chief investment officer who picks out holdings for you instead of retail products called mutual funds. So most of the times families don't know they have a choice. But if you really are about the business of your life savings, I think it may be time to ask that really tough question. Do you answer to shareholders first, or do you put my best interest first?
Wow.
Get somebody to put your best interest first. Get a fiduciary.
Very good point. And for the listeners listening out, is now that you know, the first step is gaining awareness, and then it's accepting that may or may I not have that current advisor that's looking out not just for the suitability of my investments, but also as a fiduciary standard. So if you're just tuning into What Your Money Would Say, I'm your host, Andrew McNair, and we have Chris Sleight, who's the managing director over at Global Financial Private Capital, who's our wealth manager that we hire as institutional investors to handle our select families, so that we deal with the client relations and deal with creating your financial strategy, and they deal with managing your money on a day-to-day basis. And we were talking about the zero interest economy and how, as a retiree, the times of surviving on your CD rates and getting the 3 to 5% every year from your CDs is long gone. And it's a very scary environment, because now we have this utopian belief that bonds can provide you all the income that you need, but without risking. And that's not the case. You can actually lose money in bonds if you're not careful. So the next thing I want to talk about, we've been talking about fiduciary advisor versus a suitability broker. What can a listener out there ask their current advisor to see which kind of advisor they're working with? Chris, what can they ask?
This is probably the most important thing, and it's usually the scariest thing for families, because they're really thinking they're going to offend their broker. and or their advisor. And the truth is, if they have a good quality fiduciary advisor, nobody's getting offended here. Here's the questions you have to ask. Are you able to put my best interest first? Because a lot of stockbrokers work for companies, big wirehouse companies, and we see them do commercials on TV. I don't have to list them. They are really told what products to sell. What a fiduciary does is, let's face it and be honest with everybody, Andrew, you have hired us. We work directly for you. You can fire us anytime we don't hold up our end of the deal for your select families. A lot of stockbrokers work for the big wirehouse or the products they sell. They don't have that same ability to say, well, I'm not going to sell the mutual funds for the company I work for. They feel that pressure to have to. And that's where families really start disconnecting from them. So first question I would say is, are you able to put my best interest first, or do you work for a company that answers to shareholders? Next question I would ask is, who do you manage money for, or do your teams that you hire manage money for? Is it just families like us? Because no disrespect, but if I wasn't in this industry, I'd be a pretty easy target. I wouldn't know what questions to ask. So I want an advisor whose team manages money not just for families, but also institutions. Like Global manages money for firemen's pensions, for the Guggenheim Trust. These big institutions, they've got board of directors, they have attorneys, they know what questions to ask. So when you wander into a fiduciary advisor who says, oh no, my team manages money for families and institutions, you can feel really comfortable. The next and final question is, you want somebody whose portfolios are GIPS audited. Everybody, this is GIPS, Global Investment Performance Standard. It is the highest auditing standard in over 34 countries now. It's owned by the CFA Institute, and it is something that you know when you see a firm that's GIPS audited, they've gone through independent auditing scrub downs quarterly, and then once that's been approved, it goes to GIPS for another final scrub down. Make sure you ask these difficult questions, even if they make you a bit uncomfortable. This is about the business of your life savings and never being hurt again like when the next 2008 comes around.
What a great point. You know, at the end of the day, it's your hard-earned dollars. You've worked 30 to 40 years to create this nest egg, and no one can watch it better than yourself. So don't put all the trust into that advisor. You have to take some of this action in your own hands and ask these tough questions. If you're just tuning in, we have Chris Sleight, who's the managing director at Global Financial Private Capital. And we're talking about the zero-interest economy. And there's one point I wanted to bring up and ask you. You know, with markets hitting the all-time highs, Chris, and we're experiencing a lot of volatility as of late, the wind's blowing in so many different directions, how can listeners and families protect their gains?
Well, the first thing they have to do is make sure that they have an advisor who's thinking more about conserving their principal instead of the next big opportunity, which is hard for families because for the last 30 or 40 years while they were working, they were at growth at about any cost. But now what families really have to think about is, when is it time to take my chips off the table? When is it time to lock in my gains? And when is it time to really build a portfolio that's best suited on how they feel about money? Your financial planning team, Andrew, has the technology as well. So I know when you meet a select family and you begin some of the stress testing, from time to time, it makes sense to do a standard deviation bell curve, which will tell families within 99% surety how much their current portfolio can go down in the next 2008. And it can also disclose if they're paying undisclosed fees inside those mutual funds. See, mutual funds make the majority of their profits by buying and selling stock through a broker-dealer and generating commissions. A lot of the select families that you meet and represent, they don't want strangers making commissions on buying and selling their money. So I know one of the things that you're most proud of is your team at Global doesn't make any commission trades. So you know that your select families are getting the best bang for your buck. And when you see a trade take place, it's in the interest of your families, not somebody making commissions to shareholders. So families today, just know that you have a lot of choices. And at every point of your money makes a difference. A listener family that saved $500,000, every 1 point of your money is $5,000. If you can just save 2 points a year by going from retail to institutional and having your own team, you save $10,000 a year. That's $100,000 over the next 10 years of your retirement. That can be a life changer for retirees.
Wow. Well, what's some great points. If you're a listener out there and you're trying to lock in some of those gains, I encourage you to schedule a no-cost consultation to stress test your portfolio. Chris talked about transparency, and that's the beautiful thing. Working with a fiduciary advisor, I believe in transparency. You should know the fees you're paying, and you should know how at risk your money truly is. And when we do a stress test of your portfolio, we sit down with you for 30 minutes to an hour. And sometimes I see really great portfolios, and I just give them a stamp of approval saying, you're doing great, keep it up, stay with that advisor who's doing a fantastic job. But sometimes we stick those little probes, just like they do at a heart test, and we test different scenarios that our prospective families are worried about, like interest rates increasing, high inflationary periods. And we also look at what happens if oil prices rise, if the Ukrainian crisis continues. We stress test all these things that people are worried about to see the effect it will have on your portfolio, in addition to telling you, what if another 2000 happened? How much of your portfolio would you lose again? That's a question that I think you need to know the answer to. It is your hard-earned dollars, and you've worked too hard to just wing it on a hope and a prayer.
Hey, Andrew, you know something else? Can I share something else?
Absolutely.
That we don't talk about a lot? When you mentioned transparency, something just came to me. I had a family the other week through financial planning that had 9 mutual funds and thought they were really diversified. And each one of those mutual funds had about 80 companies that made up its guts. So we sat there and realized there was 720 different stocks in those 9 different mutual funds. And what we found when we peeled back the layer and did a stress test is they had some of the same companies in all those mutual funds that gave them a huge exposure if the market went down. And that family didn't know it because they owned the wrapper called mutual fund but didn't know the guts inside of it. Part of transparency of working with a fiduciary is having your own team picking out those 80 companies for you, not the wrapper. So one of the other things I tell families is don't get lulled to sleep having a bunch of mutual funds. Understand all the companies inside those mutual funds and make sure that you're not going to get hit by having overexposure in the next OA.
Great point. And I like to give the family an analogy to elaborate on your point is the mutual fund can be a shell called a boat. And it has multiple different apartments that own singles, 1% of this company, 1% of this company. The problem is if that wrapper, is the Titanic, you could be in trouble. And so you got to make sure that you understand what's in each apartment and that you have a wealth manager that's constantly, replacing different apartments on that boat so that we can avoid an iceberg like, unfortunately, so many families hit in 2008. So,
that's a great analogy.
Well, Chris, it's been a pleasure bringing you on the show, and I want to wrap up some of the points we talked about today. In this zero-interest economy, you don't have to struggle with the 0.8% in CDs, but you also don't have to run to bonds that are risky if interest rates increase. No, there's other options out there. If you call our office at SWAN-Capital, we specialize on working with families, select families just like yourself, that are looking for locking in those gains but getting consistent income on their investments. I hope you call the office at 380-9558. That's 380-9558 to stress test your portfolio. And Chris Sleight, thank you for coming on the show.
Glad to be on the show, and I'll come back anytime.
See you next time on What Your Money Would Say.